before we get into the acquisitions, can you tell me a little bit about yourselves? Give us like a 2-minute intro, maybe to each of you, and kind of how you ended up forming Flotek. What was the kind of like thesis behind the group forming?
Yeah, so obviously the way that Dave and I met is quite a story as well. Essentially, I came from building a business on my own when I was 21, older when I was 34. During that sale process, was actually he actually worked for the corporate finance company at corporate. And so that's how we met. Dave actually sold the business for me.
Amazing.
I think it was one of his first mandates on his own, really, Dave, if I remember right on it. After that, so yeah, that's how we met, and a friendship was formed. And so when I decided to start Flotek, I spoke to Dave about the idea. Didn't think Dave would be interested in doing it with us, and he said, "Yeah, I'd love to not take a salary for 2 years, and I'd love to take a pay cut." And so we formed Flotek, and Dave was one of the three founders. Really, Dave, I'll let you
Brilliant.
add to that if you want.
That's a pretty good summary. So I come from a finance background myself. So went through an apprenticeship when I was younger, and then moved into corporate finance, which is a good grounding because you're working. It was great because you're working with a lot of entrepreneurs, like owner managed businesses. That's what we were selling. But I was only ever seeing the success at the end. You were helping someone to sell a business, and you could sort of see that a lot of hard graft had gone in over 5, 10, 15, 20 years. I had a bit of an itch that I wanted to sort of go through that pain myself. So, when the opportunity came up to work with Jay and Mal, I was like, I wanted to jump at.
And why like IT and MSP kind of arena? Is that your background, Jay, or was that just a kind of sector that you looked at and thought let's attack that?
Yeah, so my background when I was younger was IT, so that's what I studied, that's what I did. My first business was more on the comms and network side, purely because at the time there was a booming market in the sort of comms and network for things like VoIP, telephony, and whatnot. So my first business was really non-IT focused, but I think the reason we did so well was because I had the IT background to really understand the technical side that a lot of people didn't have at that time. And so, yeah, that was really how it formed. And then I think where Flotek really came in was I wanted us to have a business that brought IT and comms together, whereas I wasn't seeing that in the market. It was quite a sort of fragmented market where you had the comms guy trying his best to do really basic IT, and then you had the IT guy trying to do a little bit of comms, but nothing really sort of that sort of clever or sophisticated. And so very much it was about having the two sort of dependencies coming together. And although we keep the support desks very separate, it was really important to bring it together as a one solution.
And right from the start, it looks like you declare on your website like your strategy of growth is through acquisition. Was that kind of talked about before you started the business? Because I've noticed in like you were formed in 2022, I think, weren't you? And you did kind of acquisitions in that year. So were you like right out of the gate, this is the way we're going to grow this business?
Yeah, 100%. So for our sort of goals or where we want to get to as a business, we couldn't do that through pure organic growth. We wanted to ensure that organic growth was really strong, but we started off being very much a buy and build business, with organic growth being super important to us. But that'll come a little bit later on. We needed to sort of get out of the tracks really and sort of hit that number, because we knew that until we hit 1 million EBITDA, we were never going to be taken very seriously. And so really it was a race to get that 1 million EBITDA, so that was sort of really noticed quite quickly. And then it was, then we could be a little bit more pickier about what EBITDA we buy.
Was the plan to always kind of build something that you could sell at the end, or was this because it looks like you've already sort of had a strategy of where you want to get to in terms of turnover and EBITDA? So is there a reason for that, or was it just sort of growth for growth's sake?
No, so I think any business that you build should always be started with the end goal in mind. And so 100% we built, we started Flotek with an end goal of we have a 10-year plan, and that was really important to us. And plans change. So that's not to say it will be 10 years. It could be 8 years. It could be, 80 years. You just don't know until, you get that right time. But I think you should always have goals and milestones that you want to achieve when you have a business, because otherwise, if you don't know what it looks like at the end, how do you shape it and form it? So I think, to answer your question, yeah, we had a really clear goal at the very start. We knew what we wanted to look like, but, ultimately, we don't just want to build a business to sell it. we want to build a business that is really strong and fundamentally a solid business underneath. Because if you build a business solely to sell it, and ultimately it's all going to be about driven for EBITDAs, and it's all going to be driven for the wrong reasons, to be honest with you. You've got to have the customer at the heart of everything you do. You've got to have ultimately a really good business that isn't just focused around an M&A, because if that M&A stops, for example, then organic growth has to be able to keep up with that demand and the people that you've got in the business. So I think really for us, yes, it's having really good fundamental business, but also knowing what the end goal is as well.
Has the end goal changed at all? Because you sort of staying on the theme of sort of starting with the end in mind. What was your kind of goal right when you started in 2022, and has it changed? Have you updated it over the last sort of 4 years?
Yeah. So when we started out, we wanted to be a 20 million revenue business. That was the goal in that 10 years. And when we got to, I think about 2 years in, or just short of 2 years in, we were already hitting that sort of 15 million mark, I think. And really, I remember it was a really interesting conversation around, a table of beers actually. And we sort of said, do we want to be this 20 million pound business and really we've only got to another 5 million to get there? Do we shorten the sort of 10-year target? Do we extend the target? What does it look like? And I remember one of the board said, well, why don't we just be a really good 20 million pound business? And I said, I'm going to be honest, guys, I'm probably the wrong CEO to only deliver 5 million growth in the next 8 years, And I think the whole board just sort of smiled and agreed really that that's not going to keep me interested. And so we had to reevaluate that number. And the reality is that, we set a really big goal of we want to be a 100 million pound business, but we always say we might be a 50 million pound business in 10 years. We might be a 40, we might be an 80, we might be 150, it doesn't really matter what we are, because it'll naturally happen what we're doing in that period anyway. Again, we always come back to, we're not geared for the sort of growth for growth's sake. We are about being a really strong fundamental business, and that is the underlying reason we exist.
I think that comes across in, obviously I followed you on LinkedIn since that. I think you did a webinar with GS Verdi right at the start in 2023.
Yeah.
But I think that kind of comes across in like the cultural pieces that you post, and like I've seen like those, I don't know if it's a Christmas party or a summer's party or whatever, but like those, it looks like you're really trying to build something sustainable there. So kind of credit to you both. Just you talked about the board there a minute ago. Can you talk me through like the structure of how the company was formed and kind of what advisors you took on, and at what point? It sounds like you've made a very deliberate effort to come out the gate to grow, not for growth's sake, but to grow quickly and aggressively. And it sounds like you've kind of thought a lot about, you've been very intentional about the infrastructure that you put in place. So can you talk to me about the people that you've kind of got advising you on the deals there?
Yeah. So there's not been much advice on the deal. I think that's why obviously Dave came into the board at an early stage, because we needed to have that corporate finance knowledge and experience. And obviously that's what Dave brought. So that does allow us to be able to do our own sort of financial due diligence on deals as well. So having Dave gives us a really strong strength in that part of the business. And I think, we've got a board of 6 directors that have joined us at different times. And, you've got, from me, the sort of entrepreneurial sort of business acquisition experience. So that obviously gives us that experience. Dave from the financial point of view. Malcolm, who was the other founder at the time, he brings really strong integration experience, because his previous role when he worked for another business was integrations director. And so he comes, with a very, very strong experience in how we can integrate businesses into the group and what that needs to look like and how we process it, how we drive it. And so we're really clear about what we wanted to be at the very start, because we were looking at the market and seeing other people who had done an M&A build, and they were all very, again, fragmented in that some kept the businesses that they bought as separate silos, some weren't integrating the systems, the people, the processes. And the days of sort of buying loads of companies and then claiming the combined EBITDA as your EBITDA, those days, in our opinion, are gone. And so you have to feel, look, and be one company now. And so from the very outset, we were very intentional with our design, which was We want to be on one system, one billing system, one customer management system, one help desk, one payroll system, one accounting system. And that was really, really important. So every time we do an acquisition, we have a really thorough 100-day plan that we go, right, this is what we want to achieve in 100 days. This is what we want to achieve in the first year. And, we meet on a weekly basis on a Thursday. We have a 2-hour meeting every single week to go through exactly what tasks are left on those acquisition books. And that's really important to us.
What I would say as well is it's those integration meetings that we have. It's those boring tasks that are actually like they underpin so much of what we do. Because of the tasks that would be so much, they would be easy to move them on, kick the can down the road, not rip off the plaster. And we've definitely like developed our style as we've gone. But it is those tasks that if you don't apply the same rigor to your small acquisition as you do to your large acquisition, then at some point it will just start to unravel, and that's what we've been like really quite strict on.
Okay, I want to talk about the post acquisition work, but first of all, I want to kind of get into the detail of how you build or how you thought about building your acquisition funnel, because I think you're up to 14 acquisitions now.
15.
Presumably you've looked 15. Sorry, 15. Sack the researcher. Presumably you've looked at a lot more than you've bought. So, I mean, you mentioned then that you've obviously got Dave, the finance specialist, you've got this integrator, you've got you as the kind of visionary, you've got other people that obviously can help with this whole transition. So in terms of the structural setup, you're very much geared into acquiring businesses successfully. So how do you look at targets? How do you think about targets? What kind of metrics do you look at? What things appeal to you? What things will kind of immediately turn you off? Talk to me about that.
Yeah, it depends on the timing as well of what we're looking for on times. Like the easy options for us are where we can pick up a business and slot it straight into our existing business, where we've got similar suppliers, similar systems, and we can literally pick that up and drop that into our existing model. But there are also times where we want to acquire skill sets or knowledge or technology or other things. A really good example was we bought a business about just over a year ago called Microshade, and they were a virtual hosted desktop business. And it would have taken us probably 3 to 5 years to really build what they'd done and learn from all the experience and all the things they had done wrong in the sort of 15 odd years of them running a business. And so we picked that business up and we brought that into our business because we wanted the technology for our partners to be able to have access to that technology really quickly, because we haven't got 5 years to build something and learn from it. We need to be quicker and faster and straight out the gate quicker. And so I think sometimes we are looking for different things when we are looking at acquisitions. But I think, pipeline, as you rightly say, there's loads and loads of IT, comms businesses, technology businesses for sale. And there's also lots of buyers as well. And so I think sometimes when you're having these conversations, people think, we're desperate to do a deal. And we're like, well, look, there's as many buyers as there are sellers. And if anything, I'd actually say there's less buyers than there are sellers. And so actually, at the moment, I would say it's a really good market for us to be able to buy something at a good price. But at the same time, we'll always provide a fair offer to a business that we're going to acquire, because we want that to be a long-term relationship, not just a quick transactional buy it and you have a seller that's upset with the transaction later on. So for us, it's really about a win-win solution on how we can keep everybody happy in that deal. And as your question, we're looking for different things. I think obviously it always starts with the culture. We've got to make sure that if we're going to buy a business, that the culture matches our own culture, because it could be great financial, great EBITDA number, revenue, great synergies. Ultimately, if we're going to lose all the staff because they're not going to fit into our model, then it just doesn't work.
How do you scrutinize and analyze a business's culture, especially when you can only kind of see it from afar? You can't sort of spend time directly in the business before you make an offer and see if it's right for you. So have you got like a screening process for that?
Yeah, I think it comes with experience a little bit as well. I think you can look on LinkedIn, you can see what the staff are posting, you can see from the external point of view of what is seen. But the best time you're ever going to learn about a business is actually speaking to the business owner, because I typically find that how the business owner is typically going to flow down into the team. So if you've got somebody who is all about themselves and they're selfish and all they care about is their bottom line and all they care about is them, then ultimately you tend to find that the staff are going to be quite similar. And you'll end up, the customers are typically quite similar as well, where they're highly demanding, over-serviced. And so therefore it becomes a model that we just won't fit into. We can be quite picky when it comes to like new customers, because we don't want transactional customers. We want partnerships where, both value each other. And, and so we've got the privilege, a lot of IT companies, because they are desperate to keep and retain and win new business, they'll drop their price, they'll accept the way that customers will speak to their staff, they'll just accept anything, whereas we're a bit like, I said to a customer yesterday, I said, I get it needs to work for you, but it also needs to work for us. And right now it's not. And they didn't like hearing that, but it's, I can be a bit more picky about the customers, and I can also be a bit more picky about the acquisitions that we do as well.
Okay. And
Yeah,
in
and I
terms
think,
of like the financials, sorry, go on, Dave.
Sorry. And I was just going to say, I think on that, in terms of like source of deals, you've also got, I think your reputation sort of obviously follows you around as well. So when we were setting up, it was a bit of chicken and egg, like we hadn't done a deal yet. And a lot of our original deals probably came through like Jay's reputation in the industry, for instance, to begin with. But actually, as we've built a name for ourselves, it's a lot easier to have that conversation, because you can turn to 14, 15 previous acquisitions that you've done and say you can go and speak to any of them. And then we've also then got supplier relationships, so they know that actually if they want to keep that relationship and that base with themselves, where can they point them to? We get quite a few leads from our suppliers where they know that we're going to look after them, because equally they'll have built relationships with these companies for 10, 15 years as well.
You've done some like geographical range is always interesting to me. You guys are obviously based in South Wales. I can see you've got stuff in almost like the tip of Cornwall. You've got one in Cambridge. How did you think about the kind of incorporating those into the group, making sure they're managed properly? Making sure that it's a good deal, given that they're so sort of far away from you.
Yeah, like we're not perfect at that yet, and I think there's always improvement that we can do. But ultimately, we all set out to be a national business. We didn't want to just be a South Wales MSP or North Wales MSP or whatever. We wanted to be able to have that. We wanted that ability to service our partners from afar, and I think that was really important to do. So, when it comes to regional, we don't want to have loads and loads of just regional offices for the sake of having regional offices. We want to have like hubs in areas that we can get to our partners quickly as and when we need to. So, an acquisition that we're currently doing is on the outskirts of London, because we want to have engineers who can get into London quite quickly. And so it's really important for us to look at that regional presence on areas that we really want to cover. Like we don't have a lot up the northeast, and that might be an area in the future, but whereas at the moment, we probably turn down acquisitions in that area, because right now it feels like there's so much opportunity in the sort of southwest, the northwest, and over the east side, like London, etc., that we don't have an appetite right now to go that far up at the minute. But that's not to say we haven't got partners in that direction. But ultimately, it's not a target area for us.
Like Jay said, I think one thing we do need to be mindful of is that even as we're acquiring across the country, like you say, you can't keep every location. Sometimes you do need to just make a call. Otherwise, you're going to end up with loads of offshoots all around the country that don't buy into then the culture of the company as well. And that's one of the things that's really important. We are an office-based business. We have some remote members of the team, but we are predominantly office-based. So it is also that consideration is really important. But like I said, we're a national business, and actually, when we did that acquisition at the tip of Cornwall, we knew as part of going into that deal that their customers themselves, they were nationwide. So actually, their physical location didn't really matter so much to us. I think there's lots of factors that come into that, even just like regional preferences in terms of how businesses are going to buy from other businesses as well.
Yeah. Okay, I want to talk about post-acquisition integration, but before we do, I just want to sort of touch a little bit on due diligence. And I appreciate there's probably an element of secret sauce there for both of you, what you do, but can you share anything with us about what you kind of look for in due diligence, any kind of major lessons that you've learned from that, any stumbling blocks across any of the acquisitions that you've bought?
Yeah, like there's probably stumbling blocks on every one of the acquisitions. I think there's always going to be challenges. There's some really good ones where everything went really smooth. We've done acquisitions where the owners told the staff a little bit before the deal was done. Not purposely, in fairness, actually. Do you know what? I think something printed off once and it landed on the printer. They didn't get it in time and the staff saw something. And because it creates so much and sort of like concern,
Yeah.
that basically 3 of the staff resigned, and they only had a team of about, I think it was 8 or 9 at the time. And so, like, nearly 30% of the team walked out, and, we were like looking at this deal thinking, do we still want to do it when we've just lost all that knowledge in the business? Because they were technical people, and there was a technology they did that we didn't do at the time. And I was thinking, I don't really want to do this deal because it's quite high risk on it. And a lot of buyers probably would have renegotiated the deal based on that, but that's just not our way. We don't sort of take advantage of situations like that. But yeah, there's loads of obstacles on it. We've had it where staff have left before earnouts are finished, and we've learned from that experience. But yeah, seriously, lots of different things on it. I don't know, Dave, if you want to add anything to that.
Yeah, I think the big thing that we've done, like sort of as we've gone, our heads of terms, if your listeners do or don't understand what that is, so it's what we'd set out before we go into an acquisition. It's basically instructions to our lawyers to say what we've actually agreed between us, and that has got more and more detailed as we've gone. That's, again, it's our style. We like to try and get as much out in the open up front as possible. So actually, when we get into the later stages with the legal documents, it's a bit of an open and shut case, because it should just be what's agreed at the start is what's there at the end. And we have had, like, one of our Sympology, the deal we did last year. When we go through the due diligence process, we do a weekly call, sort of myself and the seller, sort of hand holding them through that process. And he commented that their lawyer was surprised that everything what we said was going to be in there was in there, because they said it's not often the case. And I think it's one of those things that we've sort of been very conscious of. I think with Jay being on the other side himself before, he knows, like, the emotional experience that you go through. Myself, from an advisor, we want to make that experience as smooth as you can. Obviously, we've still got a job to do. We need to validate what we've based our acquisition on. But actually, once we've validated the numbers are in the region of what we expected, then it's just about fact finding, and it's integration preparation, and it's how can we find out as much about this customer base that we're bringing in as possible, so that our sales team are best prepared, our service team are best prepared. I'd probably say, if I was giving advice to anyone who's going to do the first acquisition, I'd say don't expect perfection. What you're going into, there is going to be issues. It's not going to quite stack up how you thought. There is going to be a customer that leaves part way, or a price that increases. You can't expect perfection. And so long as your original, like what was core to you when you agreed that deal, still is still reflected, I think you need to have the confidence to sort of crack on. Otherwise, you'll never get a deal done.
Mm-hmm. Just staying on the subject of sellers' emotions, you kind of touched upon it there. I mean, one of the biggest kind of issue, I guess, that I come across is a seller's expectation of the value of their business is usually much more inflated than the market would define it as. And Dave, I'm sure you've come across this a lot in your previous life. So how do you guys navigate those kind of conversations where a seller's been in the business for 20 years and they think it's worth so many millions because of the time spent versus the actual revenue multiple that is kind of applicable in your instance? I can see you smiling there, Jay. So, I assume that you've come across this a lot. How do you navigate those conversations? And because you will find good businesses that you really want, but you don't want to overpay for them. So how do you kind of reconcile that?
Yeah, I probably on every single deal, I think people think it's worth more than it actually is. But it's like everything. People don't really know the value of something until they generally come to sell it, and then they get offers, right? And so in their head, when it's a small business, everybody thinks their business is worth £1 million, and you sort of got to remind them that you're turning over £500,000 and making 60 grand a year, EBITDA. And you're like, how can you be worth it? And they go, well, MailChimp sold for 14 times, annual revenue. And I'm like, you're not MailChimp, and you haven't got their system, you haven't got their growth, you haven't got their... And so it's a really difficult one when people are listening to what deals are on the market and what people are getting, and don't realize how the valuations are set and what a fair price to pay is. But also, I do think that, there's a lot of sellers on the market that will market your business, and to get you to pay that marketing fee to get you listed will overinflate your valuation based on valuations they've got for other better structured businesses. And so somebody with no contracts for their customers and no solid financial information or no growth is not going to achieve the same valuation that somebody who's got growth and got contracts and got all the things in order. So it is really hard, and it's a difficult conversation because, I always ask every single seller, how much do you want for your business? And I don't think I've ever had an answer back where they say to me, oh, I'm looking for this. And I always say to them, like, when you're buying a house, you don't go and see houses and guess the valuation and then place offers. There's a guide price, And so I wish people would give you a guide price of what they're looking for so that we all can stop wasting so much time on how much it is and then being so far away from the reality. Like, we looked at a business a couple of weeks ago and it was local to us and it wasn't that great, the financials, and it wasn't great, the information coming from it. And we had a couple of meetings and then we went to all the financials, had to reformat all the financials because they were so incorrect. And then when we sort of said, look, what is the valuation? And they said, oh, they want £1 million. And we were like, yeah, it was so far away from it, And I just wish people would tell you that at the start because it would save so much time. But what typically happens is these things come back around. So they'll go to market, realize that actually what we told them on the first meeting was pretty accurate, in fairness, and that's what the market is paying. And then generally within a year, they've already sold their business in their head and told their wife they're retiring or husband. And so therefore they come back around with a more reasonable and sensible discussion. And then you normally can get something done. But I would say when someone goes on the market early days, it's rarely ever done unless they're going to take a serious consideration to it. I don't know, Dave, if you want to add anything to it. You're normally listening to me negotiate these sort of things, aren't you? So, you see it.
Yeah, no, I'd echo that. I think we're quite fortunate because the sector we're in is very active for M&A. So, like we sort of said before, there's plenty of buyers, there's plenty of sellers. But also that means it's a really efficient market. So generally speaking, we know that even if we put an offer in and it's not what someone expected, if it's a fair offer, there's a good chance it will come back round if we do actually want that deal. Because we know it's a fair offer when we put that forward. And yeah, the chances are it is going to be below what someone wants because you're always going to look at your own child differently, aren't you? So
yeah, and it's a shame really that most deals are done in private, right? We see the big, like you touched on it there, Jay, with the MailChimp at 14 times earnings, and you can see what Microsoft is trading for in terms of its PE ratio. But for a business owned by Mr. and Mrs. Smith for the last 20 years, that their sale probably will never get publicly declared, and so using that as a benchmark to value your own business just isn't possible usually, is it?
Yeah, it's difficult because you don't want to be the one that's the bearer of sort of bad news sometimes, But I also think like if you have somebody who represents you properly, like when I saw my first business, like Corporate were great because they were specialists in the market, they understood the market, so they gave me a realistic valuation, and we actually achieved over what they said, and so therefore my expectations were set early on, and so I knew what a fair price would look like, and they were experienced enough to know, they would look ridiculous if they took it to market and didn't sell it, because ultimately they make their proper money on the actual sale. And so, when you look at some of these sellers that actually do the work, they make more on the marketing upfront fee than they do on the actual success fee, which tells you a lot. So I think it's really looking at the looking at the sort of reputable people out there who advise, I think is probably what I would say.
I think the challenge is when you're at the lower end in terms of size of business, so probably like sub 2 million revenue, it's hard to sell a business of that size. And if you're looking at some of the larger acquirers, it's also hard for them to buy a business of that size because of the fees that normally come with it. So that's why there isn't always that huge amount of advice out there. But obviously, as you move up the scale, you get a lot more access to that advice, and there's a lot more benchmarking you can do.
Yeah, for sure. Post-acquisition work then, let's go on to that for a minute. How has your post-acquisition kind of integration changed from the first one you did to now?
We probably had more time on the first ones. So I think, because obviously we've done so many now, and there's always tasks that are still overlapping or to be done. So I think early days, we probably had a lot more time and a lot more thorough, duty on it. So I think, I remember our first acquisition, I personally went out and met lots of the partners and chatted to them and got to know them. And, when a business owner speaks to a business owner, there's never a better conversation than that. But obviously, as we've grown, we've got, an account management team that now go out and do those meetings, and I do less of them. And so, they're not as great, for example, in the growth that we've seen on the future ones, because, I don't think you can ever replicate that business owner conversation, but we're still seeing really good growth on it. But in answer to your question, we still do the integration as thorough as we ever done. We probably do it a little bit quicker, I would say. So I think when we started out, we were a bit more cautious. Dave, would you agree with that? Whereas now, I think we're a little bit more like, let's just rip that plaster off, let's take the website down, let's redirect the website, get them emailing off Flotek quickly. And I think that's probably a bit more braver, I suppose is probably the word I would use for it.
Yeah, I think you definitely sort of develop your style of it. But I think also as Flotek itself has become bigger, in the early days when we're doing these acquisitions, they were such a bigger part of Flotek when we're doing them, because Flotek itself was very small. But now Flotek itself's a lot bigger. It's a lot easier to make those braver decisions because they're moving into something that's a bit more substantial. And the impact of that business coming in isn't as significant.
And you mentioned earlier about 100-day plan. Was that a deliberate thought? And can you talk us through what items are included in that? Because a lot of people that I speak to about, they've got so many hesitations and reservations about acquisitions, and it's kind of a really scary thing for them. Can you maybe give a few pointers to what people can think about when they acquire their first business, and what they can kind of reasonably implement?
Yeah, so I think, Dave touched on it earlier, really. I think when you buy that first acquisition, you've got to be prepared that it's not going to be beautiful, and that there are going to be things that you may not like. And there are going to be things that are going to come out in due diligence that are going to make you a little bit nervous. And sometimes you might need to restructure a deal, renegotiate a deal, whatever it might be. But what I would say to is you've got to walk into a deal knowing that there are going to be risks. And I think a lot of people pull out of deals, especially their first ones, and they never end up doing a deal because they sort of keep looking at the risks and not the reward that comes from doing acquisitions. And so we see it a lot where deals are agreed, they've gone through due diligence, they've started the legals, everybody spent lots of money, and then the deal falls over because something was declared later on that probably should have been discussed early doors. There are things that we've found out during due diligence, and you've just got to take a view that is sometimes the risk of doing an acquisition. We've had sad situations where, we had an owner pass away during the due diligence, and that was a really sad situation. And we had to deal with, the sort of son and wife during that process. And, we had to put a bit more risk our side by doing that because, the owner's knowledge wasn't there anymore. And so we restructured it, but paid the same money, just paid it over a different way and put some sort of milestones in place on it. And that allowed us to continue to do the deal, but putting a bit more risk on our side, but, pushing that over. And I thought it was still a very fair deal in what we did. And I think it's just really important to understand that, you can't go into these things thinking it's going to be totally risk-free. And if you want a risk-free deal, then you'll never do an acquisition.
Also can't price out every item of risk as well. It sounds great in theory that there's this error and that there's £1,000 here and I'm paying 4 times, so that's £4,000 to come off. But it just doesn't work like that. And I think, again, that's where it helps from our perspective. One of our superpowers is, because Jay's been on the other side, it allows us to sort of resonate. And when we talk operationally in the business, we always come back to like the customer and how does that impact the customer? And actually what really helps is when we're doing acquisitions, Jay will always pull it back to, you've got to think about the other business owner as well. Because it's very easy, especially for my side, the finance guy, sit there behind a spreadsheet and it's very easy to sort of go, this means that. But actually bringing it back to what that means for the person sat on the other side of the table, it sort of keeps us honest. And that's probably why I've been able to keep doing these acquisitions as well so far.
And the cultural side of it, obviously, like you've touched upon there, you can mitigate a lot of the risk in a financial model. Your lawyers will take care of a lot of the legal problems. How do you make an acquisition a success ultimately? because you're buying, businesses with staff in them, and like you said earlier, Jay, the first kind of thought is immediate fear of my job's at risk. They see big private equity coming into businesses and stripping the assets and sacking people and that kind of stuff. But most acquisitions, this kind of level, aren't like that at all. There, you guys are buying businesses to grow them. So how do you kind of navigate those fears with people? Have you got like a procedure in place or a set of processes that you use there?
Yeah, so when we do our acquisitions, it's always and probably always will be myself and our managing director, Malcolm, we'll go and meet every member of the team individually. So we'll do a speech in front of them all. So maybe 10, 20, 30 staff, whatever might be on it. And we'll do a speech in an open forum and just say, look, number one, your jobs are safe. We're not here to cut jobs. We're a growing business and we need really good people. So even though we might not need your role in the next 6 months, 12 months, whatever it is, there will still be roles in this business that, we want and we want you to grow into. And that's really important because I'm sure the staff will be really pleased that the owners have just landed a load of money and they might have been there for 20 years from sort of boy to man or whatever it might be. And they'll be really pleased, but they'll also be super nervous about, can they pay their mortgage? Their family going to be safe? And they'll be thinking about themselves. And so you have to just literally put that to bed straight away and just go, look, your job is safe and we're not here to cut your job. If you are really good at your job, we want to retain you and we actually find our best people through acquisitions. And so when we place an offer on an acquisition, one of the pages in our offer is actually a video of two of the staff from our first acquisition to give the business owner the confidence that we look after people. And so there's a video of me interviewing two of the team, which we put on one of our blogs or whatever, which basically is about Annie and Mickey and how they've progressed into more senior roles in the business and developed and grown and really grabbed it by the horns and have developed themselves. Whereas obviously you get other people who just go into fear and just go into denial and they sort of panic about their job and they just literally just switch off from everything and then just become really negative and could become quite toxic. And those people they don't last because we don't want people like that in our business. And so actually we always say, look, come into this in a really positive mindset. And actually what you'll probably see is some really good things in how you can develop, you can grow, you can upskill yourself. And it's just mindset. It is just pure mindset of how these people are. But having those one-to-ones with the staff is really powerful because one, it shows that we care, I think, really by the fact that we're taking the time to meet them on a one-to-one basis as well. But it also allows them to ask any questions. It allows us to get to know them. And as I say, we've often found our best people in these meetings. And I can quickly know whether somebody's going to be with us long term or whether this is going to be a short term relationship. I can very quickly work people out. And I think that's a skill I've picked up in doing what I've done over the years. And that I'll come out of those meetings and think, oh, that is a star. And that's somebody that we really need to nurture and look after and think about progressing into our business as a whole.
I'd probably say, just to follow on from that, it does change over time as well. So obviously early doors, if you're doing your first acquisition, you've probably got a lot more to prove because there's nothing that people can look back on and go, how has everyone else been treated? If next time we do an acquisition, they can look on our website and they can see that we're advertising for 10 roles at the minute. They can speak to loads of people in our business who have come through an acquisition and are progressing and doing really well. And they can see all the PR around it. So they can relate to that and it probably looks a bit more genuine. But early doors, when you don't have that track record, it is more challenging. And what I'd probably say to that is, and it's not just on the staff perspective, it's everything from customer integration, is don't underestimate the amount of time it's going to take. If you need your business to overperform and the acquisition to overperform to make it work, really think about, can you take yourself out of your business to make that happen? Because the distractions will just multiply. So don't underestimate the amount of time that you need to put into making that transition happen.
Yeah, I agree with that. And to be honest, Andrew, when I had my first business, I could never have done what we're doing on my own. And so having Malcolm, our MD, who does the day-to-day of this business, it's allowed me to focus on what I need to do to focus on those acquisitions. So I think it's really important, as Dave said, is having a team of people that are ready to integrate that business, because people underestimate how much time it takes, from the customers to the staff to the processes, the integration. It's a team of people.
Can we delve into the weeds a little bit on these acquisitions, like this first 100 days? What can you reasonably expect to happen within kind of the first 3 months, 6 months of an acquisition? And what have you kind of learned that you might need to be a bit more patient on after you acquire a business?
So the first couple of things that are really important to us is, number one, we get hold of the financials. So we want to get access to the accounting system and migrate them over to our accounting system. So we use Xero, and we've got like a
Mhm.
multi-tenant Xero account. And so that's really important that we move them onto Xero so that we've got financial oversight of the business really quickly. And that usually then involves like the debtors, creditors. So we've got a real overview of all the financials. So that is a definite in that 100-day plan. The other part of that then is really getting them onto Halo, which is our CRM. So that's what we use for our ticketing and everything else on it. So it's really important that we pick up all the customer data and drop that into Halo and start operating as the separate business. And so we can separate that database into what we call group companies. So you can sort of run it as ABC company and sort of say, right, those are their customers, those are their ticket queues, and everything can be run completely separate. And so then when the time comes of integrating, like say the support or whatever, then the nice thing is it's literally a configuration change, not a major change. And so that's really, really important. And then the other thing is things like the web domain. We want to get hold of that as quick as we can in case there's any issues. Getting hold of the email system and migrating them into our Microsoft tenant so we've got access to the data. And so those are the sort of, the 100-day things on it. Getting also the management lines in place. So looking at, for example, who's going to be the managers of each department, where do they sit, how do they structure it into our business? And sometimes that'll just be conversations, but depending on the size of it, we could also look to fully complete that manager change or that structure change basically in that short space of it as well. And so it's really important that we understand the business in that 100 days. We know, because a lot can happen in that first couple of months, so we don't want the financials to start declining. We want to make sure that we can see it before it happens. So we want to understand, what work in progress they've got, what forecasting they've got. So it's really important that we've got a grip on that because, we're not a massive business, so we can't afford for the business to decline really quickly. And so it's really important that we've got a grip on the financials and the customers.
Yeah, I'd say with the customers as well. And again, it's something that is led then from your due diligence. Is identifying, I think, leading from the due diligence is identifying those key customers and putting a plan in place to go and engage with them.
Yeah. Okay. All right. So we're kind of coming to the end. Last couple of questions, really. So you're now 15 acquisitions in. Sorry. What do you wish you'd known on day one that you know now?
Oh, that's a good question. Dave, do you want to take that one?
I'd probably say, yeah, like what Jay said, be braver sooner. I think there's probably phases that we had where we were more cautious than we needed to be. I think we probably could have been braver sooner. I think that would have been the key thing because I think that probably avoided some conflicts at the time that became issues further down the line. So that would be the main thing that I take away.
Have you got any, Jay?
Yeah, no, just a record. That really, I think, is probably just thinking a little bit more about the long term and how that will integrate in fully. So I think we're not perfect at what we do. I think we're really good at integration, but I think sometimes we can be quite guilty of sort of having it a little bit further away and not fully integrating that thing if it's too different from what we do. And actually just bringing it more into our processes really, I think is start with the end in mind as we start the call,
For somebody who's listening to this, who's kind of thinking about making an acquisition or buying a competitor, it's the first one. What's the kind of top one or two pieces of advice you can share with them to sort of help them take the plunge?
I think I'd say start those conversations early and get to know your competitors and understand who your future buyer is going to be and have a relationship with them. Because if you only go and speak to them when you're ready to exit, then neither of you know each other, neither of you know what each other's looking for. And so you should know well in advance, what this transaction could look like in a couple of years. Because if you know what your competitor's looking for, i.e. product alignment, supplier alignment, customer contracts, whatever it might be, then ultimately you've got the opportunity to increase your valuation by meeting what they're looking for. And so I often say when we get people come to us and say, I'd like to sell the Flotek one day. I go, that's great, but we need to have these conversations early because I'm not going to be interested if you're terms and conditions say one thing, or you are saying something else to your customers, and you don't have these suppliers in place, and you're selling a product which isn't very reliable, so that we pick up something that is like a falling knife. And so I think it's really important to have conversations early and just get that alignment and get the trust going, because you need to know what the valuation is going to look like. You need to know what the metrics are going to look like. I'm not saying you can know how much it's worth and how you're going to get it, but you should know what this needs to look like for the other person, because if they are your buyer, then the chances are what they want you to look like is probably what other people will want you to look like as well, I would imagine.
Yeah, definitely.
Anything to add to that, Dave?
I think one thing we often hear, especially with the sort of smaller size businesses, is a business owner will say, I'm ready to be exited. I don't have any day-to-day involvement in the business. Sometimes that's not actually a good thing, because then the customers feel unloved. Things are starting to get a bit more out of control because things aren't being monitored as they should be. But if there's proper investment in systems and process, that makes it a lot easier to then pick up, because you can rely on what's done. If the business owners exited themselves from the business, but there isn't those processes in place, the chances are over time, over the couple of months after the acquisition, you find things that just weren't being done. Things were being missed because there wasn't that. Like, no one will ever have the same care and attention as the person who, like the entrepreneur who set up the business. And when that stops, just because they want to be able to say they're not involved in the business day to day, that can cause more problems than it solves. So I think be honest with that. And yeah, put the time into systems, process, documentation, so that someone can pick up that business that's ready to go. It'll be a lot more valuable.
Nice. Okay. So final question then really is you've kind of hit your financial goal that you set out with your 20 million. What does the next few years look like for you guys now? What's your aims and ambitions, and what are you looking to do next?
Yeah, I think it's more of what we've done really well over the last 4 years, I think, is the answer to that. And so, our organic growth, we've just been awarded fastest growing organic growing MSP, and over the last couple of years on it. And, we're really proud of that, because what you typically find is a lot of M&A builders don't have the organic growth nailed down. And so we've got a really strong engine when it comes to organic growth. So I think I want that to grow and continue that sort of trajectory. But also I think it's about looking at other acquisitions and more meaningful and more sort of changing opportunities, really, because, opportunities that were 500,000 revenue about 3 years ago were interesting to us, but they become less interesting as we grow, because to move that needle, we need bigger transactions. And so I think really for us, it's probably looking at that next evolution of acquisitions that are going to add more of a transformation to us as a business. But at the same time, those smaller £1 million businesses that we've bought, they've been really successful and add lots of value to us as well. So I think really it's about doing more of what we've done really well over the last 4 years.
Yeah, no, I'd totally echo that. We know that to hit our big, hairy, ambitious goal, it's 30% growth a year. And we know we want to be driven by our organic growth. So that's the big thing that will differentiate us. So, and I think it comes back to what Jay said at the start of being a fundamentally good business. Fundamentally good business should be growing organically. So if we keep a focus on that and make sure we don't get carried away elsewhere, I think that'll be what keeps us grounded.
Amazing. All right, guys, I'll leave it there. I know you're both busy, so thanks a lot for your time. I appreciate it. I think that's some really good insights there. I like the be braver sooner thing. I really like that idea.
Good.
It's really interesting, your journey. I'm enjoying watching it. So credit to you guys, what you've built, and yeah, hope you get to your 100 million.